The dual exploration model is an upstream financing strategy built to make the exploration budget substantially self-financing. It operates by monetizing oil and gas discoveries early, creating a continuous cycle that funds the next campaign. In practice, an energy major explores at high equity and proves the resource through appraisal. Then, while the asset is still rising in value between discovery and plateau production, the company sells a minority stake. Crucially, the discovering company keeps a retained interest. They hold on to the majority stake and the operatorship. By treating a discovery as both future production and a tradable asset, an illiquid, long-dated project becomes an immediate source of cash. This sustains aggressive growth without expanding the company's debt. This chart compares capital recovery. The traditional baseline stays in negative cash flow for a decade, waiting for first oil production. But with the dual exploration model, early stake sales pull value forward. The line branches and spikes into positive cash flow within years. Eni pioneered this cycle. In 2025, they proved the resource at the Baleine field offshore Côte d'Ivoire and executed a 30% sell-down. Generating roughly €1 billion, that transaction converted a massive sunk cost into a liquid asset, immediately financing the next drilling program. This strict logic of discovering, proving, and monetizing is now being applied beyond individual oil fields. Eni scaled this strategy into the satellite model. This network diagram illustrates a central corporate node fragmenting outward, carving out focused business units. These independent nodes represent transition satellites: Vår Energy, Azule Energy, Ithaca Energy, Plenitude, and Enilive. Each of these spin-out companies is structured to raise its own capital and establish its own independent market valuation. Packaging these units so outside capital pays for them early strips away the consolidated balance sheet. For the transition satellites alone, this strategy exposes an implied combined enterprise value of over €23 billion. For B2B suppliers and technology vendors, early sell-downs and satellite spin-outs physically fragment the historical buying committees. This flowchart maps budget authority. Procurement and technical evaluation power move away from central headquarters, redistributing directly to the satellite level. When national oil companies and financial partners enter early, they introduce new stakeholders with entirely different regional priorities into the decision matrix. Because the budget holders have changed, a supplier's long-standing relationship or historical incumbency at the corporate center will not automatically secure these new regional contracts. To survive, suppliers must completely pivot their commercial strategy. Capital events, like stake sales and farm downs, are now the cleanest indicators of where new budgets will appear. Monitoring these capital market updates provides a 6 to 12-month forward signal on which programs will be funded next. This allows vendors to target the right local committees and establish procurement-ready evidence long before a formal RFP is ever drafted.